So just over that until we get the release of the latest US non-farm payrolls report. I have with me here a replica of the trophy that counts. It's not about F1, it's not about Wimbledon, it's not about the French Open or the NBA Finals. This is where it's at, right here. The trophy. I'm gonna zoom it in so you can see that engraved. A number of illustrious champions on here. You've got George Soros, you got Jans Hassias, the Goldman's chief economist, all of which were once holders of this trophy. To explain for those not in the know, and for those taking part, you have to put £1 into the cup, and then you have to submit your headline non-farm payrolls guest, Piers, sat just to my left, the winner of which will take this coveted trophy home. Don't worry, I've got big hands. It's not a small trophy, it's a huge trophy. Okay, so let's have a look at non-farm payrolls then. What we're looking for, what we're anticipating from today's event. As ever, it's been fairly quiet, certainly from a news perspective, but that hasn't really stopped the market from having a bit of movement. Certainly from the equity perspective, if I just make my chart larger here, this is the DAX. Fresh all-time highs here, having breached that early May, mid-May resistance level. All coming, of course, in sympathy with US equities. That brief period that we had, roughly only about, I'd say 2.5 weeks ago or so, when the Washington Post and New York Times were all circulating articles about the potential involvement of the Russians with the Trump administration in the run-up to the US elections, kind of foul play, Trump impeachment risk, that therefore meaning that a lot of this advancement in the equity market would need to be pared back. Very aggressive selling, and in fact some of the biggest two-day kind of downward pressure that we'd seen in US equities in months, only then to be countered by this new wave of selling. Once we got to 2400, obviously that was the previous resistance point. We broke above there. We've been in kind of a consolidation phase really since, for the last week or so. And then we've had ADP yesterday blow out expectations, setting the bit of a scene for what we're looking at for today's non-farm payroll, certainly on the headline figure at least. Combination of this as well, you've Trump pulling out of the climate change agreement, we would argue is probably beneficial, at least short term, for corporate America. No barrier certainly for continuation of US oil production to be even more rampant than it has been. So kind of continuation of that play, both to the benefit of corporates in America and to negative for oil prices. Bad news if you're a Gulf nation and you were part of this OPEC meeting agreement to extend the oil production cuts last week. So oil down again, although it has recovered, even though we've recovered pretty much 60 cents or so, we're still down $1 on the day. So looking at the S&P here, this is the main benchmark stock index in the US, and it's sitting at essentially all-time highs. Never before has it been really at this level. If I look at a daily continuation, I can make a bit more sense here. This was when the US election was held. Momentary sell-off the night of the election, only to then have this infamous Trump trade take hold. We've then had a bit of hiatus around this 2400 handle. You can see why that was such a critical level for the market on the upside. Really back in what would have been first day of March. I'm sure you'll all remember what happened on the first day of March. That was when Trump tweeted for the very first time that we're going to have a phenomenal corporate tax deal. That was when prices in the S&P really went from this lower bound of that range all the way up to that 2400. But here we are, up at these record levels. So pointing this out because how much further, certainly from an intraday or weekly perspective, can this S&P move? Likewise with the DAX, following sympathy with the gains seen on Wall Street last night, we've kind of gapped above the range that had been in play the last week. We're at all-time highs. A little bit of positioning, you would say, for a positive payrolls report. So anything other than that, are we going to see a pretty sharp move lower in quick fashion in the equity market? Obviously gold kind of telling a similar story with the general risk on theme. Gold is down $6. Again, bottom end of the range that's really been in play, going back to really the 26th of May. Certainly defining the last week's kind of price action, and definitely in the right conditions of a strong enough non-farm payrolls report, that level could well be broken in a short while when the data hits. In terms of the dollar, it's not really done anything today, which is very typical ahead of a non-farm payroll release. It's essentially flat, and so the major pairs are slightly lower, both each around 20 to 30 cents. Sterling obviously a little bit weaker in general, just given the context of further narrowing of polls that we've seen materialize, not just today, but really throughout the week. The no-show from Theresa May has not done her any favours, as the pressure on her has intensified. As a guideline, she is having a BBC special Q&A session against Jeremy Corbyn later this evening, which will be interesting. So that's kind of your setup at the moment. If we flip over on the bottom right chart, T-notes, just slight positive, really flat overall, 126.08.5. So let's look at the numbers in more detail. So non-farm payrolls, as you well know on the calendar, is a multifaceted event. Not only that, today you have the release of US trade balance, and you have the components of that report. In addition, you have Canadian trade balance, as well as Canadian labour productivity. So all the numbers I've got highlighted here are in fact everything that's going to come out at 1:30. So it's a lot of information to digest. And certainly if you're new to listening to a squawk, it's going to be a lot of noise. You might find it difficult to comprehend exactly what's being said to make sense of it all. Whenever there's a big batch of data like this, of course the most prudent thing to do to navigate this more successfully is to put it in a hierarchy of importance. With that being said, Canadian data really is not important at this point, not certainly when payrolls is coming out. Trade balance as well very much takes a second seat to the jobs data, which is seen as more influential, let's say, in terms of its ability to impact the market. So, of all that data, we've just removed out maybe several components here to make it a bit more simple to look through. Now, looking at the payrolls report itself, there's a couple of key things here. The headline of which will be the first number that will be digested, not just by human point-click traders, but also by algos. When the data's fed in, that's the first number it will react to. You'll also see, going into the data, your calendar spread, or your ladder spread, excuse me, your bid offer will widen out because of a lack of liquidity in the market. That's why a few seconds before the data hits, you get a lot of gyration in market prices because there's no one in the marketplace. Then, soon as that first number hits, the market typically spikes just on the headline figure. Now that's a really dangerous part for a new trader. Don't get caught out, because what inevitably happens is the other data, i.e. what we're looking at here with particular interest is the average hourly earnings, might tell a contradictory story. You might have a lot of jobs out there, but people aren't getting paid more, which is seen as a negative. So your positive initial move then gets reversed. That's why with payrolls, really it is the digestion of everything to then make a more concrete decision of where you think that this market might move on the balance of the perception of how strong or how bad this report is as a whole. In order, you get the headline. So that's expected 185,000 today. That's key. So that's your barometer, if you like, of the main response. Then I'd say attention next to the average hourly earnings month on month, year on year. You then look for the revision from the 211. Does it get revised up or down? Also, there's a 2-month net revision. Then you'll look at the breakdown of the other figures. Quite often what happens is after the first 5 minutes or so, you start to see a bit more of a trend materialize. The only exception to that rule really is if you get a very unilateral report where, let's say hypothetically, the headline is 300 average hourly earnings are up at like 0.6, unemployment rate falls, so something which in every single component is positive, then you get a much cleaner move and you could possibly be a little bit more aggressive in that situation. But that very seldom does that play out with this particular number. Also, this number's at 1:30. When we get to 2:30, that's when Wall Street opens, the volume picks up, certainly in the equity market, but generally you start to see asset movement across the board. That can also be when you start to see a more defined trend start to materialize. So it doesn't have to be trying to hit the data as soon as it comes out. In terms of the actual figure then and formulating what it might come out as, a couple things to keep in mind. The week leading up to non-farm payrolls is always very important for traders and analysts, because what they do is they monitor job-related data from the US in the build-up to give them a perception of what they think the official Labour Department's report, i.e. non-farm payrolls, will be when it's released today. So one of the biggest ones that comes out, generally speaking, is this one here. It's called ADP employment change, which is essentially private businesses in the US. They hired, we had this data yesterday, 253,000 workers in the month of May of 2017. Now this was significant and might go a large way to explain why we pushed to record all-time highs again yesterday, because the market's already factoring in that non-farms may well follow suit with a similarly strong report. Now, to put it in context, ADP was 253,000. The market expectation was 185,000. So you're talking about a rough 70,000 beat on the headline. So if that was to materialize today, non-farms are expecting around a similar level at 185. So, are we in for a 250 plus type number on this metric alone? Now, different banks obviously have different forecasts that they go for. Some are more bearish, some are more bullish. But certainly, as a proportionate weighting, ADP is seen as a very credible kind of lead indicator as to the underlying sentiment, or the underlying statistics, I should say, of the employment situation in the US. So hence the reason why the market is quite highly positioned going into this number. I would say, in terms of a whisper number, the balance is on the upside. So if the market's expecting either a good number or better, then the bigger market reaction will be to a negative number, a miss on expectations, because that would be completely against what the market's expecting. Other figures we've had, ISM, manufacturing, that came out yesterday as well. Pretty much keeping pace in terms of the headline figure, but new orders, and importantly the employment constituent, went up against the previous month. So on the breakdown on that particular report, showing an improved employment situation again. Now, this is non-farm payrolls as a headline. One thing to just quickly recap here, when you look at this chart statistically, you might think, wow, 79,000 in March, what happened in March? That's a real eyesore, if you like, if you're thinking about Fed policy members making decisions. They need to see consistency in data, and certainly this last 3 months hasn't been that. You've had 2 very strong months, but one particularly weak one. The important thing here is you could pretty much extrapolate that number off this chart. The reason why, of course, was the weather. You had Storm Stella impacting the northeast coast, which is obviously one of the most populous regions of North America. That then contributed to a very low print on their headline reading as 79,000, which means that most people are discounting that. And so the average is more, we're looking at 200 or just above. Now, if you look at non-farm payrolls on a slightly longer time frame, what you'll see here is a convergence really towards this 200 as a mean, if you like, and that's made the Fed fairly comfortable about the employment situation. Much like in the case of the UK here, it's not about jobs, job creation. That's fairly healthy at the moment, as to is unemployment levels. The problem is wages, and the problem is inflation. And so that wage data, hence it's so important, because the number of jobs is kind of pretty consistent. A few other thoughts here that I've picked out from Deutsche Bank, which only even further support the idea of potentially a good report today. They said the 4-week moving average of jobless claims during the May survey period was 241,000, which is the lowest for any employment survey week since July of 1973. So if you're looking at jobless claims, obviously very low at the moment. And then secondly, withheld income tax receipts are tracking up close to 7% compared to a year ago, which points to rising income growth. Since tax receipts are a direct function of employment, hours and wages, the recent acceleration in income growth should at least partly be reflected in the pace of job gains. So lots of reasons here to think that we're going to see an upside surprise in the headline figure. I would say the way probably best to look at trading this event is going to be what's the wage data like. That's going to be key. Okay guys, I'm going to leave it at that. So hopefully that gives you a bit more further insight. As per usual, just be a little bit careful on the initial release. Don't feel the need to be drawn in by the volatility. The more astute tactic might often be just to wait. That overall perception, trying to digest the report, takes some time. It's a lot of information that has to come out, and so the market can change its mind in its assessment over the very short term quite quickly, which might mean you're better served just staying out of the initial volatility. Okay guys, good luck. Let's see who comes out on top with this trophy. And of course, when you're trading it, all the best. Okay, thanks guys. 5 minutes.